You spend weeks building a trading strategy, you ran the backtest, and it looks perfect. 80% win rate, you're ready to go live. And then you lose money on your first trade. Sounds familiar? That's not the bad luck, that's a broken backtest. And today I'm going to show you 8 mistakes that make your backtest lie to you, so you can finally trust your results. Hi, my name is Sunil, and I've been designing and building trading strategies for last 10 years. Whether you're starting out or you've been trading for a while, backtesting mistakes are incredibly common and expensive. Most people don't even know they are making them. So let's break down all 8 one by one and more importantly, how to fix each one. Mistake 1, survivorship bias. Imagine you're backtesting a stock strategy using today's list of S&P 500 companies. Sounds logical, right? Wrong. The S&P 500 today only contains company that survived. What about the one that got bankrupt, delisted, merged or disappeared? If your data doesn't include those failed companies, your strategy looks way better than it actually is. This is called survivorship bias, and it's one of the most common and dangerous mistake in backtesting. What's the fix? Use a database that include delisted and defunct stock. Second, look ahead bias. This one is sneaky. Look ahead bias happens when your strategy accidentally uses information that wasn't available at the time of the trade. For example, say an earning report comes out after the market close. If your backtest uses that data during the trading hour, you have cheated. In real life, you wouldn't have that information. Or maybe you're using a moving average that gets recalculated with future data. It seems fine in the code, but it's using tomorrow's data to make today's decision. So, what to do? Always ask, would I have had this information at the exact moment the trade was placed? If the answer is no, fix your data pipeline. Mistake 3, ignoring transaction cost. Your backtest shows 40% annual return. You're already planning what to do with that profit. But here's the question nobody asks. Did you account for commission, bid spread, slippage? Most beginners skip this, and it silently kills their strategy. Think about it this way. A spread of just 0.1% sounds like nothing, but run 500 trades a year on a 1% position size, and you have handed 50% of your profit straight to the broker before the market even had a chance to work against you. For short term and high frequency strategies, transactions aren't minor detail. They are the difference between profit and loss. How to fix it? Build cost into your backtest from day one. Add a slippage buffer. If your strategy can't survive after realistic cost, it won't survive in real life either. Mistake 4, overfitting or curve fitting. This is a big one. You tweak your strategy, adjust the parameter, test again, tweak again until it perfectly fits your historical data. Congratulations, you have built a strategy that works great in the past and will likely fail in the future. This is called overfitting or curve fitting. You're not discovering a real market pattern, you're just memorizing the old data. A strategy with 12 parameter optimized for 3 years of data, that's not a strategy, that's a coincidence. How to fix this? Use out of sample testing. Split your data, train on 70% and test on the remaining 30% that the strategy has never seen. If performance collapses on that unseen data, your strategy is overfit. Mistake 5, not testing in different market regime. Your strategy was backtested from 2012 to 2021. Great bull run, of course it will work. But what happens in a bear market, a sideway market or a high volatility crash like COVID crisis? Beginner often unknowingly test only in favorable condition and assume it will work forever. How to fix it? Deliberately test your strategy across different market conditions: bull run, crashes, choppy sideways period. A robust strategy should hold up reasonably well across all of them. Mistake 6, ignoring position sizing. Most beginner backtest assume you put the same fixed amount into every trade, or worse, they go all in on every signal. In real trading, how much you allocate on each trade changes everything. Poor position sizing can wipe out even if your signals are correct. A strategy with a 60% win rate can still blow up your account if you are risking too much on each trade. How to fix it? Incorporate realistic position sizing rule into your backtest. Fixed fractional, percent of equity, or volatility adjusted sizing. Your backtest should reflect how you'll actually trade in real market. Mistake 7, small sample size. Your strategy made 12 trades in 2 years and won 10 of them, 83% win rate. But when you run it in live market, you're losing money on all trades. 12 trades is not statistically meaningful. You could get that result by pure chance. You need hundreds of trades to have any confidence that your edge is real and not just luck. How to fix it? Aim for at least 200 to 300 minimum trades before drawing any conclusion. If your strategy doesn't generate enough signal, test across multiple instruments or longer time period. Mistake 8, assuming backtest is equal to live performance. Even a perfect backtest is not guarantee of future result. Market changes, liquidity changes, your own emotion change the moment real money is on the line. Beginner often go all in after a great backtest and get crushed because they didn't account for the gap between simulation and reality. What you can do, always paper trade or run a small live test first. Assume your live performance will be at least 30 to 50% worse than your backtest. If the strategy still looks good after that discount, you might have something real.